Yes, this is a range bond market, or what we call a sideways market. Yes, at this point, at least everyone knows the meaning of a range bond market, or what we call a sideways market. And today we are going to see how we can trade or use the engulfing bar candlestick pattern in a range bond market, or what we call a sideways market. We all know that a range market moves in a horizontal direction between two dynamic support or resistance level. As we can see, the market is in indecision. It is not trending. It is between two levels, the support and resistance level, and it is moving in a horizontal direction. For that type of market, today we are going to see how we can use the engulfing bar candlestick strategy or the candlestick pattern formation with in a range bond market. Of course, the method is different from that we have been using in a trending market. So this is a ranging market, and the method of usage of the engulfing bar candlestick formation is different from that we have been using in a trending market, as we are going to observe here. Yes, one of the most difficult market to predict is what we call the sideways, or what we call the ranging market. And I always recommend traders to focus on trading trending market. But the problem is that the market spends more than 70% of their time in a ranging motion. Therefore, when a market is ranging, we cannot say that the market is in either in an uptrend or a downtrend. Otherwise, at that point there is indecision between the buyers and the sellers, and at that point there is no one in control of the market. And if you just focus on the trending markets, you will probably leave a lot of money on the table. And for that reason, we have to learn how to approach the range bond market, and it is a must for you if you want to make decent trading and make a profits using financial markets. Of course, we all know the meaning of a ranging bond market, or what we call a sideways market at this point. And here we can see that when a market stops making higher highs and higher lows in case of an uptrend, or or lower highs and lower lows in case of a downtrend, the price starts acting between specific highs price and the specific low prices, and at that point it is a clear signal that the market is in a ranging motion and no longer trading. This can be observed in the illustration that we are seeing here right now. We have a ranging bond market. Yes, as you see, it moves in a horizontal direction between two dynamic support and the resistance levels. So we are having our amplifying bar being formed at either the resistance level or the resistance or the support level, and the amplifying bar that is being formed at the resistance level is called a bearish amplifying bar candlestick, and that one that is being formed at the support level is called a bullish amplifying bar candlestick. Yes, from the illustration you can see that the market is trendless. The market is neither trending downwards or upwards. you can observe that the market is trendless and it is trending between two horizontal support and the horizontal resistance levels, and here you can't apply the same techniques that you use in the trending markets to trade the engulfing bar patterns in the range bound market. Of course, this can be simply understood. Let me give you an example. So when you are driving your car and when you are driving your car, especially in the morning or at any time, you don't always drive the same way. And if you are driving the downtown meaning, I mean driving on a steep slope, if you are driving downtown, you try to drive slowly because you know that driving fast can put your life or other people's life in danger. Whereas when you are driving in a highway, your driving style changes completely because you know that you can drive fast. So you can always try to adapt your driving style to the appropriate situation depending on the type of road that you are driving on, either a highway or downtown. The same case applies here with the financial markets, and you have to do the same thing when you are trading the engulfing bar candlestick patterns, because all the price action strategies we have discussed before will not work in the range bound markets, and you have to use the right techniques that fits these market conditions. But before talking about the right way to trade trendless markets, or what we call the range bound markets, you have to be selective about trading ranging, or what we call the range bound markets, to protect your trading account, because not all sideways markets are worth trading. You have to know how to differentiate between a sideways market and what we call the choppy markets. Yes, the area that you are seeing being highlighted is what we call a choppy market. With a choppy market, there is indecision between the buyers and the sellers, and here we cannot enter a market either by buying or selling because the market is very choppy, or we can call it a shopping market. Yes, as it is illustrated above, the market trades in a crazy way. As you can observe in the illustration, the market trades in a crazy way. You can observe this very clearly. Here we have indecision in the market between the buyers and the sellers, or between the bulls and the bears. So the market trades in a crazy way, and here we cannot identify the major support, or what we call the resistance levels, and you have to stay away from these types of markets, otherwise you will definitely damage or blow your trading accounts. Trading the engulfing bar candle formation in a ranging bond market is very simple. The first strategy is going to be about trading this price action pattern from the major support and the resistance level, and this can be illustrated in this chart that you are going to observe. Yes, this is an illustration of a range bound market, and we are seeing that we can use or trade the engulfing bar candle formation from the major support or the resistance levels. So when the prices approach either a resistance or the support level, we can enter the market by either buying or selling. At the support level, when the prices approach the support level, we are going to see the formation of a bullish amplifying bar, and at that point, its formation indicates a buy signal, and at that point, we shall have to buy the market. And at the resistance level, the formation of an amplifying bar candlestick indicates a sell signal, and at that point, we have to sell the market. So that is one of the ways that we can use to trade the engulfing bar from the major key levels, the support and resistance level. Of course, the second strategy is to trade the breakout of the range or wait for the pullback. This can be observed in the illustration that we are seeing right now. So we are having our range market. As you can see, we are having our two major levels, the support and the resistance level. So at first, we are seeing the formation of a bearish amplifying bar at the resistance level, and after its formation, we are seeing the market trending downwards, and on approaching the previous support level, we are seeing a breakout and a formation of an amplifying bar, which is also a bearish, indicating that we are going to have a market continuation downwards. So we can also trade the amplifying bar candlestick formation after a breakout from the major support level. Yes, we are seeing that after a breakout, we are seeing the prices continuing downwards. For the reason, we are seeing a bearish amplifying bar candlestick being formed at the major key support level, indicating a market continuation downwards. Yes, the third strategy that we can use to trade the engulfing bar confirmation in the sideways market is to trade the false breakout from the major support or the resistance level. So we are seeing that false breakouts are one of the most powerful price action strategies, and they occur in all types of markets. And if you know how to use such breakouts in combination with what we call the amplifying bar candlestick pattern in the major support or the resistance level, I promise you, you will make a lot of money in the market, because you will buy intelligently the bottoms and sell the tops in case of a bearish amplifying bar pattern forms in the uptrend. So this is an illustration that we can use to indicate a false breakout. So a false breakout is observed here at the resistance level. So we are seeing our wicks breaking through the resistance level. So it is just a false breakout. Therefore, at that point, we have to sell the market, because the breakout is false due to the formation of a bearish amplifying bar candlestick that is being formed in the uptrend. Yes, this is enough for now, and in our next video we are going to be learning about how to trade the engulfing bar candlestick formation in the supply and the demand zones. I just want to thank you for watching. and for you to better for you to understand all the techniques and the strategies that I always discuss with you here. I just request you to watch most of the previous video, especially from the first one, because this is like a journey that you have to take step by step. I just want to wish you a good day. Yes, thank you for watching.